The federal estate tax, it's all over the map. For people who die in the year 2012, the first $5 million that they have is exempt from this federal estate tax. It's about a 50% tax, so when it applies, it's a big deal. Now, when does someone have to file a federal estate tax return? Well, the general rule is if someone dies and their, quote, gross estate exceeds $5 million or exceeds the applicable exemption, then a estate tax return must be filed. Now, oftentimes no tax is due because the gross estate might be $6 million, but there are oftentimes a number of deductions that cause the net estate to be under the applicable exemptions. Common deductions are the marital deduction for things left to a spouse, the charitable deduction for things left to a charity. The marital deduction is the big one. So be aware, though, because there's some pretty stiff penalties for failing to file the estate tax return, and it's got to be filed within 9 months from the date of death. It's called IRS Form 706. You can Google it and take a look at it. It's a fairly extensive return. So be aware in Louisiana, if a married couple has $6 million of community property, and so the husband died, really his half is only worth $3 million if the exemption's $5 million. That filing requirement is not met. So be aware, it's a big deal, the estate tax return. Make sure you comply. We help families with that every day. I'm Paul Rabalais. Have a good one.